Hey there, Iggy the Investing Iguana here. In this video, I'm going to share with you my dividend investing, bear market survival guide. As an investor ranked 8th influential tiger by Tiger Brokers with over 370,000 reads, I've seen my fair share of market ups and downs. And let me tell you, when the bears come out to play, dividend investing can be your secret weapon to not only survive but thrive. So, buckle up and get ready to discover how you can navigate the choppy waters of a bear market and come out on top. When it comes to investing in the stock market, bear markets can be particularly challenging for investors. The uncertainty and volatility can make it difficult to know where to put your money. However, dividend investing emerges as a strategic approach that can help investors navigate these choppy waters. The appeal of dividend investing lies in its ability to provide a steady stream of income even when stock prices are falling. When you invest in dividend-paying stocks, you receive regular payments from the companies you own, regardless of what's happening in the broader market. This can be particularly comforting during a bear market when capital gains are harder to come by. But the benefits of dividend investing go beyond just providing a reliable income stream. By reinvesting those dividends or simply holding onto them, investors can actually cushion the impact of falling stock prices. Think of it like a built-in safety net for your portfolio. As stock prices decline, the dividends you receive can help offset some of those losses, making the overall downturn less painful. Finally, a history of profitability is another key indicator of financial stability. A company that consistently generates profits is more likely to have the resources to maintain its dividend payments over the long term. While a company may occasionally have an unprofitable quarter or year, a long-term track record of profitability suggests that the company has a sound business model and is able to effectively manage its operations through various economic cycles. In addition to these quantitative factors, it's also important to consider the qualitative aspects of a company's financial stability. This includes things like the quality of the company's management team, its competitive position within its industry, and its ability to adapt to changing market conditions. A company with a strong and experienced management team, a durable competitive advantage, and a track record of successfully navigating past economic downturns is more likely to be able to maintain its dividend payments during a bear market. Of course, no company is completely immune to the effects of a bear market, and even the most financially stable companies may experience some volatility in their stock prices. However, by focusing on companies with strong financial foundations and a history of consistent dividend payments, dividend investors can increase their chances of generating reliable income and preserving their capital during market downturns. At first glance, a high payout ratio might seem attractive to investors who are looking for immediate income. After all, the higher the payout ratio, the more of the company's earnings are being returned to shareholders. However, a payout ratio that is too high can actually be a red flag. Here's why. If a company is paying out most of its earnings as dividends, it may not have enough money left over to reinvest in the business, fund research and development, or build up cash reserves to weather economic downturns. In other words, a high payout ratio can be a sign that a company is stretching itself too thin and may not be able to sustain its dividend payments in the long run. So, what is a sustainable payout ratio? While there's no hard and fast rule, a payout ratio of around 50 to 60% is generally considered to be healthy. This means that the company is paying out about half of its earnings as dividends, while retaining the other half to reinvest in the business and build up reserves. Of course, the ideal payout ratio can vary depending on the company and the industry it operates in. For example, mature companies in stable industries like utilities or consumer staples may be able to sustain higher payout ratios because they have more predictable cash flows and fewer growth opportunities. On the other hand, younger companies in high-growth industries may need to retain more of their earnings to fund expansion and may have lower payout ratios as a result. When evaluating a company's payout ratio, it's important to look at the trend over time. A company that has a history of consistently increasing its dividend while maintaining a stable payout ratio is a good sign. It suggests that the company is generating enough cash flow to support its dividend payments and is committed to returning value to shareholders. When it comes to identifying strong dividend-paying companies that can weather economic downturns, sector stability is a crucial factor to consider. Some sectors, like utilities, consumer staples, and healthcare, tend to be more resilient during bear markets because they provide essential goods and services that people need regardless of the economic climate. Let's take a closer look at each of these sectors and why they tend to be more stable during challenging times. Utilities companies, such as those that provide electricity, gas, and water, are often considered a safe haven during economic downturns. These companies provide essential services that people and businesses cannot do without, which means that demand for their services remains relatively constant even during a recession. Additionally, utilities are often regulated, which can provide a degree of stability and predictability to their revenues and cash flows. Consumer staples, which include companies that produce food, beverages, household products, and other necessities, are another sector that tends to hold up well during bear markets. People need to eat, drink, and maintain their homes regardless of the state of the economy, which means that demand for consumer staples remains relatively stable. Moreover, many consumer staples companies have strong brand recognition and customer loyalty, which can help them maintain their market share even during tough times. Healthcare is another sector that tends to be less sensitive to economic cycles. People get sick and need medical care regardless of the state of the economy, which means that demand for healthcare services and products remains relatively constant. Additionally, many healthcare companies, such as pharmaceutical and medical device manufacturers, have strong intellectual property and patent protection, which can provide a degree of stability to their revenues and cash flows. Of course, it's important to note that not all companies within these sectors are created equal. Even within a relatively stable sector, there can be companies that are more or less risky depending on factors such as their debt levels, competitive position, and management quality. Therefore, it's important to do your due diligence and carefully evaluate each individual company before investing. Of course, dividend investing isn't just about picking the right stocks. It's also about managing your portfolio effectively. Diversification is key, so don't put all your eggs in one basket. And if you really want to supercharge your returns, consider reinvesting those dividends through a DRIP, Dividend Reinvestment Plan. By automatically using your dividends to buy more shares, you can take advantage of the power of compounding and potentially score some serious gains when the market eventually recovers. But here's the thing, dividend investing during a bear market requires patience. It's not about making a quick buck, it's about building a portfolio that can provide steady income and growth over the long haul. So, if you're ready to buckle up and ride out the storm, dividend investing might just be the strategy for you. Alright, there you have it, your ultimate dividend investing, bear market survival guide. By focusing on financially stable companies with a strong dividend track record, keeping an eye on payout ratios and sector resilience, and managing your portfolio with diversification and patience, you'll be well equipped to weather any market storm. Remember, bear markets don't last forever, and by investing in solid dividend-paying stocks, you're setting yourself up for long-term success. So, stay the course, keep collecting those dividends, and watch your portfolio grow. If you found this guide helpful, be sure to smash that like button and subscribe to the Investing Iguana channel for more insights on navigating the wild world of investing. Leave a comment below with your favorite dividend stock pick or any other topics you'd like me to cover in future videos. Stay savvy, my friends, and happy investing.